Hello, ladies and gentlemen. My name is Greg Michalowski. I'm the Chief Currency Analyst for FXDD, also a contributor to Forex Live and FX Street. Here, three of these webinars. I have one scheduled here for today and another one scheduled later on in the month, toward the end of the month. So I look forward to these opportunities to share my knowledge with people, the listeners out there and the users of the FX Street. I'm very fortunate and honored to be able to speak with you on this platform. My also do Twitter on Forex Live. My web commentary can be found at www.forexlive.com. I remind everybody that all part, a little bit more than a little more of your risk capital trading foreign exchange. It's a leverage product, and so you must be aware of that, and also that during this webinar, I'm not going to give any buy, sell, or hold recommendations. I'm going to give you some trading methodologies, trading strategies that you can use, but I'm going to be constantly focusing on risk. Risk is very important in your trading. Anyway, this disclaimer outlines all those things that we must present to you, and hopefully you understand before we get going here in our webinar. So with that said, and you have the opportunity to read that, let's get started. And part of becoming a successful trader, in my mind, is trying to recognize the type of markets we are trading in. And for me, the types of markets are either trending or non-trending. Either markets trending to the downside or trending to the upside, or it's in a non-trending environment. Prior to today, we were kind of in a little non-trending environment in the shorter term. I'm looking at the euro. But today, what do we have? We have a trending market. So if you as a trader can recognize the types of markets that we are in, you will be better suited for trading that market. You will have a better methodology. You should also have an understanding of how that market in a non-trending environment trades and how that market trades in a trending environment. And one of the things that a lot of people will do, and a lot of retail traders will do initially, is not understand or try to understand what type of market it is and what type of trading they should be doing for that particular day. But nearly every day, I will default my self, if you will, at the beginning of the day to thinking that the market is going to trend. And the reason why I do this is to understand is because trends are where the most money is either made and lost in the market. I have a mission statement for my trading, and I hope that you, as a trader, may think about adopting this mission statement. But my mission statement, and what I think all traders' mission statements should be, is to make the most amount of money with the least amount of risk. To make the most amount of money with the least amount of risk. So, in order for me, if that's my mission statement, it behooves me to think in terms of a trending market and to look for trends, and because that's where the most money is made. Trending markets. Trends are fast. Trends are directional. Trends tend to have larger trading ranges than non-trending trading ranges. Just look at today's trend move to the downside. The euro has a larger trading range than a non-trending trading range. In fact, we were in a non-trending market before the market started to trend. So non-trends transition into trending markets. Trending markets transition into non-trending markets. But if you're looking toward this idea that the market has the potential to trend, you're going to be more likely to catch those trends and to stay on those trends when the market starts to move. And there are ways that the market will tell you that the market is continuing to trend. We'll look at that as we move along. Now, there also is a feeling out there, and you all can kind of answer this yourself. But there is a feeling out there, and I hear it often from people in seminars or webinars, that the market trends only 30% of the time. So for me, my idea of, well, I'm going to always default toward looking for the trend, how does that fit in? That only happens 30% of the time. The market only trends 30% of the time. But what I like to remind traders is that idea depends on what type of time frame you're looking at. If we were to look at this time frame in June 18th and June 19th, and we looked at where the market started to trend to the downside here, started to trend to the downside somewhere around this area, around the 127.11 area. And the market trended all the way to the downside, moved down to 125, 60 or 50 something down here. Pretty good trend move to the downside, right? No one would say that this is not a trend. In fact, look at all the candlesticks. They're red, a little green one here, red, all the way down. That's a trend to the downside, isn't it? Now we have this period of non-trending where the market has some green, has some red, and then we get this period of green candles and the market trends to the upside. So, and where do we trend back to? Right around that 27.11 area right here. So if someone was looking at this chart and looking at this market right here from a longer term perspective, maybe from a daily perspective, they would say, oh, well, the market's not trending. We had this this move to the downside, move to the upside, basically changed over a 2-day period, had the same low, same high. What's the diff? This market is non-trending. But for me, I see a trend, a non-trend, a trend, and most of the time I spend in a trending market over this time period right here. So don't get caught up with this idea that the market only trends 30% of the time. No, there's trends all over the place in the market, and you as a trader have to be able to see those trends. The one thing that we don't really know from even this activity right here is, will the market continue the trend to the downside here? Will the market continue to reverse and trend the other way? We don't really know that, and there are clues in the market that and using market tools that will tell you that this trend was over. This move to the downside was over. One of them was this move back about maybe holding above the 200. This green line is a 200 bar simple moving average. The fact that it held against this level here, moved back above the 100, which is this blue line right here, and guess what? It couldn't trend anymore. We couldn't get below the 200-hour moving average. Can't get below the 200-hour moving average. Guess what it's going to do? It's going to move back above the 100. If it stays above the 100 like it did right here, it's going to move back higher from there. This is the importance of using technical tools, importance of following what the market is saying. Now, Boinke says, and then my point is that daily would show non-trending, and you're absolutely right. But trending in non-trending, this is trending, non-trending on a daily chart. On the hourly chart, I would love to catch this move. I would love to catch this move, and there's some clues in the market that I actually gave you. So it all depends upon the perspective that you're looking at. That's why I'm always looking for trending markets in my trade. And what I will do then is look for the market to tell me when the market is not trending. And in this chart right here, the market was saying, well, the trend was over when it couldn't get below the 200, when it started to move back above the 100, when it started to hold the 100. It was saying, well, this market is really not trending anymore. In fact, it has a potential to move the other way, and that's exactly what it did here. Now let's take a look at a longer-term chart and take a look at this type of activity and try and define trends and non-trends. And so this is a daily chart. What we saw in the month of February, March, and April was largely a different market than we saw in May. I mean, we saw in February, March, and April, we saw down, up, down, up, down, up. And in May, we saw this market, nice little trending, long-term trend to the downside. And what have we seen since that time? We've seen up, down, and today we actually making a little bit more of a break to the downside, aren't we here? But it doesn't necessarily mean, this doesn't necessarily mean that it's this just yet. It may be. I mean, we're moving lower here today, but we're in this type of area in here, right here so far. We don't know how far it will go, whether it's going to trend, it could continue to trend and have something move like this to the downside. But what we know is that this looks different than this, and this looks different than this. This looks very similar to this, matter of fact. So these are different types of markets. These are different different markets. One is trending, and one is non-trending. Recognizing what type of market you're in is going to give you an idea of how to trade that market. And so traders need to trade the yellow trends, trend to the upside, trend to the downside, trend to the upside, trend to the downside, trend to the upside, smaller than these types of moves, than the green trends. This is still trending. This is 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 trending. And this is trending. But this type of activity is much different than this. And so what I try to do is trade or have a different mindset for the different types of markets that we experience, trending or non-trending, and how to approach those markets, how to trade those markets. And there's a different way for each. Specifically, traders, what I like to say is that traders need to fall in like with these types of markets and fall in love with these types of markets, the green markets, those bigger trending markets. These little trending markets are the fall in like markets. These types of trending markets are where you want to fall in love with the market. And typically what you will see, ladies and gentlemen, is that when the market is trading in a fall in like type range for an extended period of time, it'll transition into a fall in love type market where you want to love being short for an extended period of time and get those bigger moves in the trend. But in these fall in like stages, they will have these mini trends along the way that you have to trade a little bit differently. You want to be in like with it, not be in love with it. So what does falling in like with a trend mean? And what it means to me is don't tell your friends and family. Just it means that you don't trust it. It means that you don't marry it. In a dating like terms that I'm trying to play out here, you are playing the field and hopefully having a good time doing it. By the way, I don't believe in that type of thing in my personal life. But what I'm trying to say is that in a falling in like market, think of it like you're single and you're trying to find your true love, but yet really quite you're not really sure. And so you don't go and tell your friends, maybe tell your friends, but maybe not your family that I'm dating this girl, and she's a nice, it's not to that point where you want to start telling the world about that girl. The same goes true in the market. We're in a falling in like type of market, you don't want to go blaring out loud that you think that the euro's going to 1.1876 or it's going to parity or whatever. And on the other side, you don't want to say, well, it's going to 145 or 140, 135 or something. You kind of want to keep it on the hush a little bit. The other thing that you in a falling in like with a trend means is that you don't trust it. You kind of give it a little bit of trust when it starts to have these mini trends, but you have a wary eye toward it. Same goes true in a relationship. You just met someone. You don't necessarily, and you like her. You don't necessarily give your full trust to her. Maybe at the start, maybe you're a little bit, you're still feeling each other out, and that's natural. And that's what you do. And I think in a fall in like type market, you want to have that same feeling, that feeling of, well, I trust you a little bit, but don't trust it fully. And you certainly don't want to marry your position. You don't want to marry the girl that you just met. You want to understand about her more. So you don't marry a position in a falling in like type trend market. You want to play the field. You want to think in terms of maybe dating someone else on another weekend or getting to know someone else here and there. And in trading terms, that means you want to be long and you maybe want to be short at times. And so in that type of market, that's what I look for in a falling like type market. In those yellow type markets, that's what I like to look for in those types of trading environments. So what does a falling in love market mean? Well, it means that you go and tell your friends and family. You're shouting out loud that this market is trending to the downside. We have lots of room to go. This market could really go further. And typically, once again, they tend to come after a non-trending type of environment. So if the market's non-trending for an extended period of time, like we saw prior to the May period, you start to think in terms of the market has the potential to trend. And so when it starts to trend, when it starts to break out, you start to think in terms of this has more, I'm really getting to love this market. I don't no longer like it. I'm going to transition into loving the market. And if we went back to those periods or that chart, we'll go back to it right now. If we go back to this period right here, when the market started to break below this low here, we had this break below, correction up, and then break right here. It really started to gather momentum here. Correction up here, gather momentum to the downside. That is this is a transition from falling in like with the market to falling in love with the market, and that's what you should be trying to do. So, looking at the current environment, just looking at this daily chart, if we're down here, I don't know where we're at right now, but if the market's down here, broken below this trend line here, we still have to get through this low here before we can really start to fall in love with the market. We're liking the trend to the downside. Don't get me wrong. It's okay to like that market to the downside, but until it starts to break the downside here further, we still have we're still kind of in fall in like with the market type range. And then when you fall in love with the market, you want to marry it. You want to stay on that trend. If it breaks through that low, you want to continue to love this market to the downside and use the tools, use the technical clues that the market gives you, and that's going to lead the way for you. It's the one for you, and you hopefully have a good time trading that market. So can the type of market be figured out in the current environment? Can the environment that we're in can we figure out the current trend for it? And for me, even today, although some things have changed here today that were a little bit unexpected, which I'll touch on in just a second. But for me, I'm still in this fallen like type environment with or fallen like with type feeling with the market. I think it's hard to pick the winners. The winners being, is it going to be the euro? Is it going to be the dollar? Is it going to be the sterling? Is it going to be the dollar? Is it going to be the yen? Is it going to be the dollar? In the current market environment, it's more difficult against those major currencies to figure out which is going to win and which is going to lose. And so why is that? And you take a look at, the statistics in the global, look at global GDP in most different countries, and have the GDP in the U.S. kind of moving down, expectations, being lowered for the growth in the U.S. Eurozone, we know, is weak. China's growth, 8.1%, but look at the trend to the downside here. They cut their rates in China here today, didn't they? Japan, we're getting a rebound from a year ago, but their growth is sluggish. UK growth minus last 2 months. the German growth, the strong nation of the eurozone, weaker, Canada GDP on the downward projection. So you can go on, you can see, that things are kind of the same. New Zealand's doing okay, but they've gotten bounced back from last year's the earthquake that destroyed their country last year, so they're getting a rebound. And we see Australia doing a little bit better. So what do we see in Euro Australia? We see the Euro Australia going down. So that may be a trade for it. But speaking against the majors kind of caught in the same type of situation. We know the global CPI data is going down. We see the trend down. Well, CPI inflation is not a problem. We see manufacturing ISM data out of each of the countries. Very similar patterns here. Down, little rebound, down, little rebound, moving back down, down, little rebound, moving back down. Japan, continue, staying around the 50 level, not doing much down, little move up, moving back down. Germany doing the same pattern. Similar type patterns. In Canada doing a little bit better. They're at 60.5 in the IV, but kind of unreliable at times. Australia performance and manufacturing index, nice rebound in the last month, but still below the 50 level here. So Swiss PMI very similar. So a lot of similar things. Now the thing that's causing the market a little bit of anxiety here today and causing the euro to trend further to the downside here today is probably more reflective in what we've seen here as far as the employment situations in the U.S. and Euro. And, I think the expectations coming into the U.S. employment report tomorrow was that the employment report was once again going to show some weakness in the U.S. and see a tick up perhaps in the unemployment rate, a less jobs created. But what did we see here today? Well, we had the Challenger and the ADP employment report come out much stronger than expectations, certainly from the ADP employment report, which is supposed to reflect what the non-farm payroll report is going to be tomorrow. And so what did we see? We saw, and at the same time, we saw the EU and the UK cut their rates or do some stimulus in their economy. ECB cut the rates by 25 basis points, and the UK Bank of England added some more liquidity during quantitative easing. So I'm not surprised that we're seeing the euro trend to the downside, and maybe the fact that there's unemployment here in the eurozone trending to the upside, U.S. coming to the downside. Now, this unemployment rate in the U.S. coming to the downside, a lot of people have left the workforce, and some people are a little skeptical of the fact that we're seeing this trend to the downside because of the people leaving the workforce is skewing this number more to the downside. But nevertheless, we're seeing more of a downtrend here, an uptrend here, and the fact that we had better employment statistics coming out of the U.S. has the market a little bit scared about what tomorrow's number would be. Will it be strong just like we saw in the ADP? And that's why we're seeing the euro move lower and the dollar move higher here today. But overall, employment situation, is still, even at 8.2 in the United States, still a weak scenario. So what else do we have going on in the Eurozone and in the United States? Well, we have Greece, Spain, and Italy in the Eurozone. We have central bank policy uncertainty. Well, I did this yesterday. It's a little bit more certain now what the ECB is doing. U.S., we're going to have uncertainty coming up with the FOMC. What are they going to do? Are they going to do more QE? Do they have to? Whatever. We have political uncertainty in both the U.S. and in the Eurozone. U.S., we're going to have that election coming up in November, and how will the balance of power within the executive and the legislative branch pan out? What does that mean for the economy? We have banking concerns in both countries, and it's summertime, so all this uncertainty says it's for me at least right at this point, and it's likely to not going to be a time to fall in love with the trend. We do have a trend here today, but it's not. It's still a time to maybe fall in like with the market, or keep that attitude about falling in like with the market, not trusting it, not marrying it, thinking in terms of the market has the potential to move to the upside, has the potential to move to to the downside. So let's take a look at some charts and get to the nitty gritty of what to do in this type of environment, in the falling in the like type of environment. Now, what we saw in this area was that we did have trends. We had trends to the upside, trends to the downside, trends to the upside, trends to the downside, trends to the upside. And in this environment, we have trend to the upside, we have a trend to the downside, trend to the upside, trend to the downside. So we're not in this environment here yet. Now, what we are in it is a downtrend environment right here. And I'm not saying that this isn't a trending market. It is. It's a trending market to the downside here. There's no doubt about it right here. But what we need to see is a breakout in order to push the market further in a direction of a falling in like with the market. So when the market did this move to the upside or move to the downside, move to the upside, what do we know or what can we tell from this area here? And the way I look at this market here and look at this chart and analyze this chart and try to figure out, okay, extreme levels which are important, I try to keep things as simple as possible. I try to outline levels that I can trust, that I have a feeling that the market is going to pay attention to. And once you do that, you kind of be patient and wait for those levels, look for those opportunities, and take advantage of them when they come. So one of the opportunities that we had here in this current fall and like type of market, and it kind of gave me a clue that the market is in a non-trending phase, or some of the things, is that we held this 38.2% retracement. This is of its move to the downside. So right off the bat, holding 38.2% retracement was saying, all right, it's not, this trend to the upside is not bullish. It's not totally bullish. In fact, when you look at it in terms of this respect, it's kind of bearish. And so you expect the market to roll over and move to the downside. Now, this trend move to the downside, if we didn't have this activity back here, this trend move to the downside, what would normally happen is a trend to the downside, correction of 38.2, and then a move back to the downside, a move through the 3 old lows, a trend move to the downside. But what did we see here? We didn't see that move to the downside through the 122.86 level. So it's at this point right here that I start to be a little bit skeptical of the intentions of of the market, okay? The intentions of the market to trend to the downside, to continue the trend to the downside. At this level right here, in fact, if you look at 124.38.7, we somewhere around that area, 124.30, 30 to 38. We had low here, we had a 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 low here. And what did we do here? We broke to the downside here. What would you expect the market to do on a break to the downside? Continue its move through this low. It didn't do that. This is the distrust that you as a trader have to start to look at, to start to say, it didn't do what it should do. I don't love this market. I like it. I only like it. I liked it down here, but I don't like it anymore when the market starts to move to the upside. That's what happened when the ECB came out with the decisions. The market moved sharply to the upside. Market said, don't fall in love with it yet. Fall in like with it, and the market started to trend back to the upside. Now where did we go to the upside? And this other line here at 127.038, what does that line represent? Why did I put that horizontal line there? After all, we went up to 127.44, 45 up here. Now it's 38.2. Why did I put a line at 127.038? And the reason why I put a line at that level is because if you take a look at the closing levels over this period here, over this non-trending fallen like type period that we're developing here, the highest close that we had was 127.03.08. So the market knows this, okay? It knows the high, it knows the highest close And notice here where the market stalled. The market stalled right below that 127.0308. So the combination of moving to the upside, failing to move to the downside, moving back up to the upside, coming back to the old high says another indication to me that this is a fall in like type market. It's not a fall in love type market. So I cannot put my full faith and trust in this market. And so that goes up to the high. And so now what do we see here? We see this trend move to the downside here. And we're starting to move here in new areas. We broke below trend line, moved below what I call this extreme. Now, let me talk a little bit about this extreme. This extreme here, when we first moved down, we came up to this high and then moved down, and we spent most of the time below this line right here, 127.0308. Look at all the time period that we spent in this period right in this area right here. Lots of time, very little time above here, a little time up here, little time down below here. Most of the days are spent here. So now we're breaking down into this extreme area here. That's going to say something to me. That's going to say that, okay, you got to go with it. You got to continue to like this market to move to the downside. But we got to get through the low here. We have to get to the, we have to move below this low in order to prove its low. So what do we have here today? We have a trend like move. Do I still like or love the market? And when I like something, you like it until you don't like it anymore. So the one thing about this market, and we've seen over the near term, is that it went up to that 127.03 level and it started to move down. So that said to me, it can't get above the highest close over the last month. Start to sell the market. Think in terms of taking this love and moving it toward take this like of the buys and moving it toward liking of the sells, and that's what started to move to the downside. So we've seen this trend move to the downside. But when you like something, you like it until you don't like it anymore. And how do you know when the market, when you don't like the market anymore? When it starts to tell you clues that the selling of the market is over. So the market today is focused on this sell, euro. And so you want to stay short, and I'm focused on the euro here today. Stay short until the market says get out. And so you like the trend, you like that move until the market says get out. And that's when you start to not like the market. So today in my commentary at Forex Live, my first comment that I posted up on the website here today said this. It said it painted the picture here, and this is before the interest rate announcement. And what it outlined here is the BOE increased their rates by 50, or increased their QE by 50. The People's Bank of China cut their one-year lending rate by 31 basis points. ECB has on tap for the next move, expecting 25 basis point cut to 0.75 from 1%. Now, it's in here where I start to, this is all the fundamental stuff. It's in here where I start to get into, all right, well, here we are. What is the bias? What do I like? What is the, how do I like this market? Do I like it to the downside or do I like it to the upside? And what I noted here, and I always take a look at the market from the current rate, where the current rate is here, and I'll bring up the chart here in a second here. You'll see it more clearly. But what we know here is the euro dollar is trading below the 200-hour moving average for the entire trading day in a very narrow trading range, 46 pips. 20-day average is 123 pips. The 200-hour green line in the chart, that's this line right here, and I'll bring it up here in just a second, comes in at 125.36. A move above this should lead to further upside momentum. So from my analysis and what you should do at it, we'll get to the time frame. It's just an hourly chart. What you should do, folks, is determine the bias here, and I'll get the chart up here in just a second for you. The bias here was price below the 200-hour moving average. That's bearish, okay? That's the bearish side, but from this perspective, the bias is bearish. But if it should move above this level, off of whatever happens, with the interest rate decision and the comments and all the other data that came out here, if it moved above this level, that's where you turn your like to the downside to like to the upside. You understand? So it's through the technical clues that the market gives you that eventually tells you when you want to not like the shorts and you want to like the longs. And if you follow these rules, if you follow what the market is telling you through the price and through the tools, you'll be better off. On the downside, the bottom trend line comes in at 124.856. So let's get to the actual chart that I was looking at and take a look at it more clear now that I've read it. But what we see here, and what I was referring to, is this. Look at that. Look at how the market stayed below the 200-hour moving average right here. It stayed below this level. And by the way, if you took a look at this retracement level, it was about 38.2%. So we moved a little bit above it here. But for all these hours, 1, 2, 3, 4, 5, all these hours here coming into the interest rate decision, the market stayed below that 200-hour moving average. So if you're short from up here, if you're short from up here, if you're short from anywhere up at these higher levels, there's no reason for you to get out of this position. You are still short as long as the price can stay below the 200-hour moving average. If it moves above it, then it's not as bearish as it was. And since I'm in a fallen like with mode of the market, I have that mindset that I don't trust this market as far as I can throw it. If I have that fallen like with the market, that would have been my stop. That would have been the time where I say, get out of this. It's not doing what it should do. If it does this and it moves above this, it's now bullish. It's now turned the bias a little from bearish to bullish. And I got to fall in like with being on the buy side rather than being on the sell side. Now, on the downside, what would make me more in like with this sell position? What would make me feel better about being short? What would allow me to perhaps move my stop level down and manage a trade in a more to lock in some more profit, keep my like of the market to the downside, and allow me to manage my stop further down. If you're short from up here against this trend line, 1, 2, 3. Against this trend line, not a bad place to sell right here. If you're short from up here and then you go through the 100-bar moving average, guess where your stop is? This trend line. When the market breaks below 200, guess where your stop might be? This moving average. When the market breaks below 200 and goes below this trend line, where's your stop? I'll move it down even further. And so you manage the trade to the downside. So what would make me more confident? Break below the 124.86 level. A break below that level is going to look for more downside momentum. So even with no position on, if I didn't have any position on, I'm looking at this market and falling like with the market saying, all right, we can go either to the upside or the downside. It depends upon what's going to happen here at the ECB, what's going to happen with the Challenger, what's going to happen with the ADP, and then let the market price decide. Let the tools in the market price decide. If it breaks below here, we should see further momentum. If it breaks above here, we should see further momentum to the upside. It's as simple as that, folks. You define your levels in fallen like type of the market, and if it does what you think it should do, go with it. Let it go. Let it move. And so what exactly happened? Well, when the market, when the decision came out, we were up here in a non-trending environment. This is a 1-minute chart because I just wanted to show you that Alex 124.86 level. This is this level right here. 124.86 is a parallel channel trend line here. Tested it here, tested it here, went a little bit below, it failed, came up to the 200. This is a fast move to the downside, corrected up, move back down. So this is a key level, 124.86. So so if I put a horizontal line on a 1-minute chart, 124.86, what happened? The market moved down to 124.82. It came up to 124.87 right here. Came up to that level, gave you that opportunity to sell at that 124.86, and once it broke through that level, boom, it was all over. It started to move to the downside here. The trend started to go to the downside. We saw the momentum. The momentum was in that you could still trust the short side, and couldn't you? You can still see the move going to the downside. So that's what we saw in in the euro, it started its move to the downside. It was all predicated on the break of that trend line. So now the move is into the extreme area from the daily chart. If you remember the extreme area from the daily chart, that level came in at the 124.06 level. Let's get the chart up here again. And what we saw here, this is our daily chart. And so we've moved, we spent most of our time over the last month and a half in between these two areas. And I outlined the extreme areas up here as down here, as right here. And now we're in this area right here where the market actually broke below this extreme area, this extreme low right here. Extreme low came in at the 124.06 level. How did I define that level? Well, that level on the downside actually corresponded with this low right here. This was a low prior to the ECB decision. This is where the market turned itself around, moved above that 38 level right here. This is where the market's trust in the downside, this breaking of this line right here at the 124.38 level, this trust in the downside was not very, you didn't like it anymore. That trust was not really trustworthy, and the market started to move to the upside. So when it broke through here and went down to the 06 level, this was an extreme, and this extreme also corresponded with this low, by the way, right here. So we had the last low here, the low here, held that level. So this level became a low. So we're now below that line right there. So we're in this extreme area. This extreme area can happen in a fallen like longer view of the fallen like market, and so you still a little skeptical until the market breaks to the downside here below the 122.86 level. You still have to say, all right, prove to me that you can continue this short move to the downside. So the question becomes, where would the price have to go to turn the intraday bias from bearish to bullish? Where would the price have to go? Knowing this is our extreme, knowing the 124.06 level is an extreme, where the price have to go in order to turn this bearishness to perhaps more bullishness? And we only have to go back to this area this point right here to get the same answer, get to the answer. This level was a nice little floor here. We broke below it and we failed, and the market came back to the upside. This level is a nice little floor here with a low here, a low here. What level would the market have to get above to turn your trust of the downside into mistrust or distrust of that downside and a move to the upside? And the answer comes in at the 124.06 level. 124.06 and above, if the price were to move above 124.06 and above, I would turn my like to the downside into a little bit less like of the downside and potential for this market to move back to the upside. Stay above that 124.06 level and follow that market back to the upside. Follow that correction back to the upside. That's where the market may, actually move further away, move further to the upside. So what do we see? What do we see here today? We saw the market move down. We saw it move up. We saw it move down. And where did the correction come up to here? How far did this market go after it broke through this 26 level, extended to the downside? And where did the sellers come in? 124.048. That's where the market held the highs. It came right up to that level and said, we still like the downside. We're still okay with this way, the way that it's going, this trend that it's going. And so until the market can prove itself and get back above that 124.06 level, I ain't going to buy it. I'm going to continue to like the sells. I'm not going to buy it until the market should start to move above that 124.06 level. And if the market turns from like to love, we'll know it. Well, how will we know it? We're going to break through the low. We're going to break through the low. But you should be short until the market tells you, get out. And when it tells you to get out, it's going to be at this point where the 124.06 level starts, when the market starts to move above that level. And guess what is the next target on the top side after it breaks to the 124.06? 124.38. If we get above this trend line that was just broken here today, you can bet that the market has the potential to move further to the upside, and we might continue in a pattern like this, movement where the market does its ups, its downs, its ups, its downs, its ups. And so Although we see what we see here today, and well, I don't even know where the market is. Let's go to the live charts right here and take a look at that, and then we'll take some questions and we'll finish this up. So let me take my screen off, put my screen on, come back over here. All right, do you see my chart there? It should be the euro versus US dollar on a daily chart. Can I get, can you see the screen? Yes, okay, good. All right, so again, I don't know where the market is. Oh, well, now I know where the market is. So you should just have an hourly chart, and let's go to the 5-minute chart. So what we've seen here is that we saw that 120.406 level hold, came up to the 124.04 level, and we've seen the market continue its trend move to the downside. And so how would I approach this market from this point right here? Well, what we know, from the daily chart is 124.06 level is going to continue to be a key level. So we need to break above the 124.06 level. Let's go to this 5-minute chart. And the reason why I put the 5-minute chart up in a trending market is because it tells you a lot about the market's intentions, about the market's love of the trend or like of the trend. Right now, I have to say that the market likes this or loves this trend. This market is trending to the downside in a nice way. And how do I know that they like this intraday trend, this trend that we've seen? And what I like to look for here intraday is for a move, a sharp and fast directional move to the downside, followed by a corrective move that holds 38.2 or below the 38.2 to 50%. I call this correction zone. And what we saw here was the first move to the downside. We didn't get anywhere close to this 38.2. And why is that? Well, because the market had broken a key support level. We broke through this key level on the hourly chart right here at the 38, 124.86 level. Market fell through that level key level at that point. Now, the other level that it broke through here was the 124.38 level. That level was this trend line off the daily chart. 124.38 was that key trend line. So when I come to the 5-minute chart and I put a horizontal line at 124.38 here, what we saw was the market move sharply to the downside below that 38 and come up and go up to 42. So it went from 38 to 45. The high was 45. And the market then started its move to the downside. So we just had fast and directional move through the 38, last stop skin hit, come up to the 45 and break back below that and move to the downside. This is an indication. It didn't get through the 38.2. This is an indication that the market is selling to the downside. So now what do? We take a look at this leg to the downside. And this is what I like to put the 5-minute chart up. You put this move to the downside. Now you start to look at the same 38.2 and 50% of the trend of the leg of this last leg to the downside. I'm not looking at the total move to the downside. I'm just looking at the trend move to the downside. Trend move to the downside, correction. Trend move to the downside, correction. Double bottom here, 38.2 comes in at 94.8. The 50% comes in at 124.045. What do we know as well? 124.06 is our key level from our daily chart. And so if the market is going to continue this trend, it's going to continue to love this intraday trend to the downside and potentially turn this daily trend from like to love, we got to stay below the 06 level, below this correction zone, below the 06 level. We stay below that level and stay below the 38.2. The market, or stay below that level, then the market has the potential to continue the trend to the downside. If it moves above, I start to lose that love for the trend to the downside today and start to like the market again, looking to get above the 38.2. So that's how I look at the market. We'll take a quick look at the sterling versus US dollar here to here. Do you see the sterling chart? You should see the sterling chart now. And like the euro, we broke below trend line support here at 155.38. Let's take a look at the 5-minute chart and try to analyze the moves to the downside. First leg to the downside, correct less than the 38.2. Things are looking good for the trending market. Second move to the downside here from this point to this point. market has corrected above that 38.2, above that 50%. So we're starting to lose some of that bearishness in the sterling versus U.S. dollar here. What would not like to see, and what traders would not like to see, is a move above the 36 level. So we're coming right up to that level at the 36 level here. I'm starting to lose a little. If the market should break back above this trend line right here, it's going to lose some of its bias to the downside, isn't it? All right. Okay. If the U.S. data tomorrow is weak, do you think the euro dollar will bounce back? Yes, I would expect that the euro dollar would bounce back, and that I think may cause this market to get a little bit skeptical about the further move to the downside. We're losing some momentum here, broken below or the trend to the downside has lost, but we're going to continue to watch this 06 level. Let the market tell you when to get out. Sell in May and go away as with would you say sell in May and go away as with stocks? In May it was a nice sell in the month of May the market was a nice little sell. It's a coincidence, whether it's a coincidence or not, but the high in May was the first day of the month, the low in May was the last day of the month, and this is the first day of June. We started below and started this move back and forth to the downside, up and down. In the currency market, anything can happen. I think what we're seeing here in the market, folks, is that there still is going to be a lot of different stories that are going to be told that are going to dictate direction. Today, the market has Euro ECB easing. We also have the better employment statistics coming out. We have one where the economy's weak, or the data, the most recent data is weak, and we have the U.S. We have stronger data coming out. The stronger data is a bit, I'll believe it when I see it. See the employment number tomorrow. So we'll see what happens in the market. But clearly today the market gave you that opportunity to sell further above at that 87 level, and that was it. All right, so you have to be short. Get above the 06 level, get above the 38 level. Tomorrow, what I'll say, if the price doesn't get above the 38 level here today, I will say tomorrow through the employment number, get above the 38 level, move back above that trend line, move back above this trend line. I'm assuming that the market's not going to correct all the way through the 38 level here today, that we're going to die somewhere in this area. But if we get above that 38 level, then my love of this trend is now turned to a like of the market, a like of the market, and like of the move for a move back to the upside. So what else we here? We're running out of time here. Someone's asking about the dollar versus Canada. Dollar versus Canada fell below the 200-day moving average here today at the 101.14 level. What does that look like? What should a market have done on the break of that 100-day moving average? It should have gone lower. The market should have gone below that, and stayed below the 101.49. We held it here. We broke below here, and the market could not sustain that move to the downside. Let's put a 111.40. What level is that? That comes in at 111.14, not 49. 111.14. So here's the 111.14 level. So we fell below it here, moved above. Look where the market corrected about. Once the market fell below this 14 level, moved to a new low, and we broke back above it. Where did we go? We went right up to the 100-bar moving average. So what did we do? The market fell back off. This is the 100-bar. Fell back off, and we fell below the 14 level, and moved back above the 14 level, and then started to move to the upside. Dollar Canada, looking at this chart, looking at the intraday chart, I've got to, and looking at the daily chart, this 200-day moving average now, it becomes support, 50% 200-day, 111.14 support, 111.21 at 32, I'd be more inclined to be a buyer with a stop below the 200 bar moving average. I just look at this failure right here, move back above, is bullish. Or it kind of turns the tide a little bit more to the upside. And I don't know what oil prices are doing or whatever, but if we get weaker, if oil prices start to come back down again, dollar goes up, Canadian dollar goes down. So maybe the oil correction is over and the market has a potential to move back up. I don't know. But from a technical perspective, I don't want to put a fundamental slant on. From a technical perspective, I see a failure here. Once you have a failure of a key level on a daily chart, especially after testing here and testing it here, I turn my love of this trend to the downside to more of a like or a distrust of that move, and now looking for the rotation back to the upside. So I think here's one last question. What do you think of the euro yen, sterling yen? Happened in Japan, cuts rates too. We're getting to the point here, where it seems like we have a concerted effort to cut interest rates. That's another thing here is that we had the Bank of China, we had the euro. If the Japan cuts their rates, what should that do? Well, on the surface, by themselves, it should weaken the yen, right? And we should see a decline in the yen, a rise in the euro yen, a rise in the sterling yen, a rise in the dollar yen. But when you look at it from a whole, what has changed? Well, nothing really has changed. So like the euro, we have this move to the downside, move to the upside, move to the downside. This held 38.2, very similar to what we saw in the euro. We're kind of in this fallen like with the type market. I would probably put a low here and break below that level, and we have further potential. The other extreme would be down here. So we're in this range here. Both countries cutting their rates would mean that it's probably range bound, probably trading in a range. All right, that about does it here for me today. Thank you very much for everyone coming in. I think I answered everyone's questions. All countries cutting interest rates in order to survive will that lead to depression. Well, they're trying to avoid that, but clearly they're worried about you cut rates. Why? Because cut rates and provide stimulus. Why? Because you're worried about things not working out. So there are definitely some concerns about that. Have a great day. Thank you very much to the people at FX Street for providing me this opportunity. I hope you learned something in this market. And we'll see. Watch that 124.06 level here today and the 124.38 level tomorrow. I think it's going to be key level. Stay below it, and the bias remains to the downside. Move above it, and we have potential to extend higher. Bye bye now.